Today, we will begin Chapter 6. We will be discussing Part A, Learning Objectives 6-1. Chapter 6, Inventory and Cost of Goods Sold. Part A, Understanding Inventory and Cost of Goods Sold. In the preceding chapters, we dealt with companies that provided a service. Service companies such as FedEx, United Healthcare, and Marriott Hotels generate revenues by providing services to their customers. Part A of this chapter introduces the concept of inventory and demonstrates the different methods used to calculate the cost of inventory for external reporting. Learning Objective 6-1. Understand that inventory flows from manufacturing companies to merchandising companies and is reported as an asset on the balance sheet. Inventory includes items a company intends to sell to customers in the ordinary course of business. It also includes items that are not yet finished products. For instance, lumber at a cabinet manufacturer, steel at a construction firm, and rubber at a tire manufacturer are a part of inventory because the firm will use them to make finished products for sale to customers. Inventory is generally reported as a current asset on the balance sheet. An asset because it is a resource of the company, and current because the company expects to convert it to cash in the near term. At the end of the period, the amount the company reports for inventory is the cost of inventory not yet sold. But what happens to the cost of the inventory that is sold during the period? The company reports the cost of inventory it sold as cost of goods sold, which is an expense on the income statement. So, manufacturing companies and merchandising companies both have inventory. Manufacturing companies produce the inventories they sell rather than buying them in finished form from suppliers. Manufacturing companies buy the inputs for the products they manufacture. Thus, we classify inventory for a manufacturer into three categories: raw materials, work in process, and finished goods. We won't go into much detail about manufacturing companies in this chapter or in this course, as you will deal with this a lot when you take ACC 121, Managerial Accounting. But to understand inventory for a manufacturing company, think about a cabinet maker. Cabinet maker buys the lumber in order to make the cabinets. The lumber that they have bought but not yet measured or sanded out or anything is the raw materials. They have them and they're ready to build, but they haven't done anything with them. The work in process is the lumber that's been cut, sanded down, it may be attached in some form, but it's not yet ready to sell to the end user. Once that cabinet is complete with the doorknobs and the hinges and the stain and everything, it's a finished good that is then ready to be sold to a merchandising company. Merchandising companies can be broken up into either a wholesaler or a retailer. Wholesalers resell inventory to retail companies or to professional users. For example, we've all heard of Cisco Corporation. Cisco supplies food to restaurants, schools, and sporting events, but doesn't generally sell to the public. So Cisco is a wholesaler. Whereas retailers purchase inventory either directly from the manufacturing company or from a wholesaler and then sell the inventory to the end users. Examples of retailers can be Best Buy, Target, Lowe's, etc. So this is an example of a balance sheet for a manufacturing company versus the balance sheet for a merchandising company. As you can see, for the manufacturing company, they have three different inventory accounts: those raw materials, the work in process, and the finished goods. Whereas your merchandising company, Best Buy, only has one category: merchandise inventories. Inventory's journey begins when manufacturing companies purchase raw materials, hire workers, and incur manufacturing overhead during the production. Once these products are put together, you have the work in process and eventually a finished good. The finished good is then flowed through to a merchandising company and becomes the merchandising company's actual inventory to resell. Then they sell it to you, the end user. Some companies also sell services to customers. For example, IBM generates revenue from selling inventories of hardware to you, the end user, as well as providing services like consulting, system maintenance, etc., to you, the end user. In this chapter, like I said before, we will focus on merchandising companies, both wholesalers and retailers. It's important to note, service companies record revenues when providing services to customers. Think back to the prior chapters. We ask ourselves, did we provide the service? If we did provide the service, then we recognize the revenue. Merchandising companies and manufacturing companies record revenues when they sell inventory. So you're going to be asking yourself, did I sell the inventory to the customer? If so, you may record the revenue.